for the first time in its 120-year history, and it is done.
It's right on the screen this morning, Dow 21,000, we go there.
So hey guys, so Bitcoin soared past 5,000, which is...
Dow Jones Industrial Index has just hit an all-time record high, passing the 23,000 mark for the first.
Whoa. First time ever, Bitcoin crossed above $10,000. And in this video,
the 24,000 mark.
Sleep last night, Bitcoin has already hit 15,000, and not only did it hit
25,000 just a few minutes ago. Nicole at
Bitcoin is at $20,000 each now.
Be wrong. It's a very exciting day. We are going to be very close to 26,000 or above. There goes the bell.
Bluey here. This is going to be a three-part series about the world as it existed back in the 20s and 30s. Nearly 100 years ago, but honestly the parallels are so many and so widespread that I think it's worth a review. So come on along with me. I'm not sure I'll get this done in one video, but let's go back to the roaring 20s and take a look at what the United States looked like back then and what was going on. We'll work our way forward in time, and I think you know what happens in this story, but let's go ahead and tell it really quickly. The 1920s marked a decade of increasing conveniences that were made available to the middle class. By and large, Americans as a whole were weary of war and looking for a way to put the horrors of the last few years behind them. New products made chores around the home easier and resulted in increased leisure time. Products that had once been too expensive were suddenly affordable due to new forms of financing that made it possible for families to spend beyond more existing means. New forms of advertising resulted in the sale of increased goods through capitalization of consumer hopes and dreams. For the first time, it became possible for Americans to buy on credit through the credo of buy now, pay later, practices that ushered in the roaring 20s. Generous lines of credit were offered by department stores for families who were not able to pay up front, but who could demonstrate their ability to pay in the future. Installment plans were also offered to buyers who were not able to pay up front. More than half of the automobiles in the nation were sold on credit by the end of the 20s. As a result, the consumer debt more than doubled during that decade. Overall, the goal of most Americans was to put the fear and uncertainty of the World War I behind them and return to normalcy. The country emerged from the war with a new respect around the world. President Woodrow Wilson became poised to lead cooperation in an international arena. With his death, the spirit of international cooperation ended, and the Republican Party subsequently dominated the remainder of the 20s. While there was a brief depression during the first part of the decade, it eventually receded under the stewardship of President Warren Harding and the institution of federal spending and tax cuts. When Harding died suddenly in 1923 and Calvin Coolidge took control of the economy, matters began to change. By the middle of the decade, the economy had once again become sluggish as the reserve banks relaxed requirements for credit and more than $500 million was created in new money. Loans totaling more than $4 billion were made available to the American public. The hope was that such a measure would stimulate the economy. However, the opposite occurred as more and more consumers took on increasing amounts of debt and the price of stock and real estate began to skyrocket.
1929. As the dizzy decade nears its end, the country is stock market crazy. The great and the humble, the rich man and the working man, the housewife and the shop girl, all take their daily flyer in the market, and no one seems to lose.
To skyrocket. In 1926, Coolidge supported the Revenue Act, which reduced taxes on individuals with higher incomes, but offered little relief to middle-income families. After Coolidge decided not to run for office 2 years later, Herbert Hoover emerged as the candidate for the Republican Party. When he was elected to office, it appeared as though the American economy was stable. Within a year, the exact opposite was true. Hoover found it increasingly difficult to gain control of a rapidly worsening economic situation. As a result of the panic, stockholders selling their stocks too rapidly for the system to be able to compensate, the stock market fell in the fall of 1929. Stocks were no longer traded at face value, but were instead sold at whatever price they would bring. The economy of the United States was destroyed almost overnight. Factories, banks, and companies around the nation began to close, and millions of Americans suffered unemployment as a result. More than 5,000 banks collapsed, and by 1932 there were 12 million people out of work in America. While the United States boasted the largest economy in the world in the 20s, across the ocean Europeans struggled as a result of the end of World War I. With the fall of that stock market, a chain of events was set off that would plunge America into the deepest and longest economic crisis of the country's history. While the stock market crash is often viewed as a single largest cause of the Great Depression, there were actually numerous underlying causes that sent the country into a downward spiral. During the 1920s, American companies earned record profits. Most of those profits were reinvested in further expansion. By the end of the decade, businesses had expanded to the breaking point. Workers were no longer able to continue fueling further expansion. Corporate profits had skyrocketed, however the wages of workers had only increased at an incremental rate. This served to further widen the distribution of wealth in the country. More than one-third of the American assets were owned by 1% of Americans. As a result of the concentration of wealth in such a limited manner, economic growth was limited. Wealthier Americans tended to save their money rather than putting it back into the economy, while middle-class Americans were already stretched by purchasing vehicles and household appliances through installment plans. In addition, there were fundamental weaknesses in the structure of the American economic system. No guarantees were offered by banks to their customers. This resulted in a panic when times became difficult. There were also few regulations in place for banks who subsequently loaned money to individuals who recklessly invested in stocks. Due to low agricultural prices of the 20s, farmers became unable to achieve any type of recovery. The downward slide was made even worse as Europeans were purchasing fewer and fewer American products as a result of their own economic difficulties. At the same time, stockholders were experiencing a boom. The prices of stocks soared to record highs. Between 1925 and 1929, the total value of the New York Stock Exchange increased from $27 billion to $87 billion. Stock fever swept throughout the country. The rapid expansion was further fueled by a risky practice that made it possible to purchase stock on margin, meaning that an investor could borrow money, sometimes up to 75% of the actual purchase price, in order to purchase a larger amount of stock. Borrowers often paid as much as 20% interest on loans, certain that the potential rewards were worth the risk. Such practices became increasingly commonplace, in spite of warnings issued by the Federal Reserve Board. In my next segment, we will examine what happened when the bubble burst in 1929. Do you see any similarities to today's robust stock market and increasing debt leverage and out-of-control federal spending? I do. Back at you in a little while.